All right, let's dive in. Sometimes a company's financial report is way more than just a bunch of numbers. It actually tells a story. And today, that story is all about Alaska Air's fourth quarter, a performance so good, so unexpected, it absolutely floored Wall Street. We're going to break down exactly how they pulled it off. So, to really get why this was such a big deal, you gotta understand the backstory. Heading into the end of the year, nobody was expecting much from Alaska. I mean, the economy was kind of shaky, and on top of that, they were in the middle of this huge, messy merger with Hawaiian Airlines. So yeah, most analysts were just expecting a pretty boring, quiet quarter. But a quiet quarter was definitely not what happened. Instead, Alaska just came out and posted results that didn't just beat predictions. They completely shattered them. Which leads us to the million-dollar question we're digging into today. How on earth did they do it? Okay, so the first piece of this puzzle really comes down to one number that got everybody's attention, the earnings per share, or EPS. It's pretty simple. It just tells you how much profit the company made for every single share of its stock. And this was the number that got everyone talking, 43 cents a share. Now, I know, on its own, 43 cents might not sound like it's going to change the world. But trust me, when you see what everyone was thinking it was going to be, the story changes. Big time. I mean, look at this. The gap here isn't just big, it's a canyon. The Wall Street pros, the people whose entire job is to predict this stuff, they were forecasting just 11 cents. Alaska came in and nearly quadrupled that. This wasn't them just inching past the finish line, they sprinted right through it, making a huge statement about how well they're actually running things. So, where did all this extra performance come from? Well, the number one reason, by far, was the shockingly smooth and successful integration of Hawaiian Airlines. Merging two airlines is famously, notoriously, a nightmare. But somehow, Alaska managed to do it at an incredible speed. So the golden ticket here was getting what's called a single operating certificate. The best way to think about it is like this. Before, you had two separate football teams, Alaska and Hawaiian, each with their own playbook. Well, this certificate from the FAA basically says, okay, you are now officially one team using one playbook. That means one way of scheduling pilots, one way of routing planes, the whole shebang. And when you look at the timeline, you really see how fast they were moving. The deal to buy Hawaiian only closed in September of 2024, right? A little over a year later, they have this super important certificate that's basically light speed in the airline industry. It puts them way ahead of schedule to start getting all the financial benefits, the synergies of the merger. That's when 1 + 1 actually equals 3. And what does that mean in the real world? Well, it means they can now mix and match their crews, their planes, their maintenance schedules, everything, across both the original Alaska and Hawaiian networks like they were always one company. This just creates massive efficiencies. It lets them be super flexible with their routes to meet demand, and here's the kicker. It unlocks huge cost savings much sooner than anyone thought possible. Okay, but it wasn't just about the merger and saving money. No, Alaska also showed some serious muscle when it came to making money from sources beyond just your standard economy class ticket. First up, let's talk about the front of the plane. Revenue from first class and other fancy seats shot up 7% compared to the year before. That's a huge signal that business travel is roaring back, and people are willing to pay up for comfort, which is, you guessed it, a very profitable part of the business. And then you have cargo. I mean, get a load of this, a massive 22% jump in cargo revenue. With all of us ordering everything online, Alaska is using all that empty space in the belly of its planes, especially on those key West Coast routes, and turning it into a serious moneymaker. And of course, you absolutely cannot ignore the powerhouse that is their loyalty program. The mileage plan is basically a cash machine, and it grew another 12%. They make a ton of money selling miles to credit card companies, and that creates this really stable, super high margin income that isn't really affected by whether people are traveling or not. What makes all of this even crazier is that they weren't exactly flying in clear skies. The airline was actually flying straight into some pretty strong economic headwinds during this quarter. Yeah, this really lays it out perfectly. You had this constant battle going on. On one side, you had major headwinds, like a government shutdown in November that hurt travel demand, plus fuel costs were just painfully high. But they fought back with some powerful tailwinds, like that strong corporate travel we just talked about, and they were just laser focused on keeping their costs down. In the end, their strengths just completely overpowered the challenges. And make no mistake, that shutdown was a huge deal. The company actually put a number on it. it cost them between $25 and $30 million in revenue. So the fact that they could just absorb a hit like that and still blow away expectations, wow, that just says so much about how strong and resilient their business really is. All right, so after a quarter like that, the big question is, where do they go from here? Well, the company gave us a peek into 2026, and their forecast shows they're feeling confident, but also pretty cautious. So for 2026, they're predicting earnings somewhere in this really wide range, from $3.50 all the way up to $6.50 per share. So why so wide? Well, it's basically them saying, look, the economy is a bit of a wild card right now. The low end of that range prepares for a slowdown, but that high end, that shows you it's possible if the economy stays strong and those merger benefits really start to kick in. And they're not just sitting back and counting their money either. No, they are pouring cash into their future fleet. They're adding more than 100 of Boeing's newest and most fuel-efficient 737s to cut costs on their domestic routes. And here's the big one, they're bringing in the 787 Dreamliner. This is a game changer. It's a long-haul plane that will let them replace Hawaiian's older jets and maybe even open up some really profitable new international routes. So here's the bottom line. Alaska Air has pulled off a near-perfect merger, is making money from all sorts of different places, and it has navigated some really tough challenges to deliver an absolutely incredible quarter. The real question now is, can this amazing execution help them fly through all this economic uncertainty and reach a whole new level? That's what we're all going to be watching.